All right, let's take a look at the Treasury yields this morning. You do see slightly lower yields, but that 20-year is now at 5.1%, just over that. The 10-year at 4.58, the 5-year at 4.13, and the 2-year above 4% as well. This came after a big jump in yields yesterday, a lousy 20-year bond auction. For more insights and volatility on the bond market right now, what it means.
What do you call it when the world's largest economy accumulates $4 million in debt every minute, just as its largest creditor cuts off support? Imagine the U.S. enters the second quarter of 2025 expected to have $850 billion in cash flow, but only half of that shows up right then: China's massive sell-off of U.S. Treasury bonds amounting to $1.7 trillion has caused the dollar to plunge and forced Washington to borrow $514 billion just to keep operations going. Mortgage rates are soaring, inflation is rising, allies are starting to withdraw, and suddenly U.S. public debt is no longer the safe investment it once was. This is not a random incident, it is a global warning. So what will happen next? This could rewrite the rules of economic power. The U.S. is now accumulating debt at an astonishing rate: $4 million every 60 seconds. But that burden becomes much heavier as China begins its massive sell-off of U.S. Treasury bonds. Beijing has sold $1.7 trillion in yuan bonds, triggering a borrowing frenzy that forced the Treasury to raise an additional $514 billion. This figure is up 317% compared to forecasts made in February. Bloomberg reports that this sell-off comes after Washington banned U.S. banks from supporting a $5.3 billion IPO of a Chinese electric vehicle battery company. This move is not just financially motivated, it is also a geopolitical blow, and China has retaliated strongly. The dollar plunged 9%, bond yields soared, and gold prices spiked as investors fled from dollar-denominated assets. Currently, the U.S. is funding its global strategy with money it does not have. While the world wonders if Washington can still control the situation, it all began when J.P. Morgan and Bank of America were asked to withdraw from the IPO of the Chinese electric vehicle battery manufacturer. This company is involved in China's strategic technology sector and is listed by the U.S. Department of Defense as part of the military-industrial complex, not a regular business. The banks faced legal pressure if they did not comply, so they withdrew. But the cost was not just the 0.2% underwriting fee. Reuters reports that losing access to China's financial ecosystem could result in billions of dollars in future losses. China has not only issued a press release, they have liquidated a significant portion of U.S. public debt. Now, Washington is facing market chaos and the consequences of turning private banks into pawns in the geopolitical chess game. The timing is not coincidental, it is meticulously calculated. China has reduced its holdings of U.S. Treasury bonds to $759 billion in the first quarter of 2025, the lowest level since T16. While increasing gold reserves to 2,292 tons, marking the fifth consecutive month of increases, according to the People's Bank of China. This aligns with a strategy to diversify reserves amid rising U.S.-China tensions. IMF data shows the dollar share in global reserves decreased from 64.7% in 2016 to 57.4% in the third quarter of 2024. Unlike previous sell-offs, this time it is not just market noise, it is a deliberate signal. The question is whether the U.S. can maintain its economic dominance as its largest creditor rewrites the rules of the game. By the beginning of the second quarter of 2025, the U.S. Treasury was expected to have $850 billion in cash. Instead, they only have $46 billion, less than half of what was planned. This enormous shortfall, exacerbated by the federal debt ceiling being reinstated in January, has forced the government to borrow far more than anticipated. A statement from the Treasury indicated that without this cash drop, the borrowing amount for the quarter would have been $53 billion lower. Why are officials maintaining outdated forecasts when the numbers are clearly worsening? Bloomberg reports Wall Street traders were preparing for a borrowing figure of around $255 billion, not nearly double the amount they actually have to borrow. This gap raises serious questions about how fiscal policy is managed in real time. If the Treasury has miscalculated the starting point to this extent, what else in their financial roadmap could be flawed? Some analysts, like those at Wrights and IAPs, hope President Donald Trump's tariff increases will boost revenue for the Treasury and patch budget holes. But early signs indicate the opposite. Take Apple as an example. They forecast a $900 million due to tariffs in the second quarter of 2025, and they have started discussing raising iPhone prices. Meanwhile, consumer inflation rose to 3.4% from 2.2% in the previous quarter, largely due to rising import costs. This is not just a temporary fluctuation, it is a structural pressure. As imports decline and corporate profits are affected, tax revenue may not keep up with the growing burden of rising interest rates from higher bond yields. If the initial tariffs were intended to stabilize the budget, data shows they are tightening the squeeze. Behind every Treasury bond auction is a family paying more and receiving less as China withdraws from the U.S. Treasury market. The yield on 10-year bonds has surpassed 4.6%, reaching 6% by May 2025. This has pushed mortgage interest rates to a 15-year high of 7.8%. According to Freddie Mac, auto loans are now at 9.1%, and average student loans are at 6.6%. Affordability is rapidly declining. The Consumer Price Index rose to 3.4% in the first quarter, up from 2.2%, with food and energy costs leading the way. This is not just economic friction, it is real pain. Bloomberg noted that household purchasing power has decreased by 5.1% year over year. The heaviest impact is felt by middle-class families as imported essentials become more expensive due to a weakened dollar. Speaking of which, the dollar has fallen 9% since China's massive sell-off of bonds, and those costs are rising. The bigger issue is as Washington scrambles to adjust, it is not foreign investors who are under pressure, it is American consumers. In the first quarter of 2025, foreign investors sold off $317 billion in U.S. assets, marking the largest capital outflow since 2016. According to Treasury data, even our allies are being cautious. Saudi Arabia, once among the top 10 holders of U.S. Treasury bonds, has cut its holdings to $126.4 billion, a 22% reduction since mid-2024. This is a wake-up call. The American economy is under pressure, and the impacts from China's pivot are felt right here. Global finance is shifting beneath our feet, and it is happening much faster than many realize. Congress has just passed a bipartisan directive forcing BlackRock and Vanguard to withdraw $812 billion from 220 Chinese companies. That figure is not merely a statistic. It is a signal that global capital flows are becoming a political battleground. The result, Asian IPOs on Yusan Exchanges are plummeting in 2025. Only 28% of Asia-based companies chose to list in the USIS, down sharply from 75% 3 years ago, according to the Wall Street Journal. Meanwhile, Tokyo and Frankfurt are stepping up, witnessing increases in listings and demand for bonds. The U.S. is not only losing investor confidence, it is also losing its status as a global financial safe haven. Allies are quietly withdrawing, which is harder to recognize than open opposition, but much more dangerous as it develops. While Washington relies on public debt to project geopolitical power, Beijing is building alternatives. By 2026, China will implement a national credit rating system to reduce dependency on Moody's, S&P, and Fitch. Why the Chinese Academy of Finance and Industry states that these Western rating agencies have pushed borrowing costs for Chinese state-owned enterprises up by as much as 120 basis points, despite their stronger economic fundamentals simultaneously. China is upgrading its domestic payment systems to reduce dependence on SWIFT, the dollar-dominated network vulnerable to U.S. sanctions. And this is significant. BRICS processed $56.4 billion in transactions just in the first quarter of 2025, with nearly half in local currencies. According to Bloomberg, these are not small-scale experiments. These are deliberate moves to shield Beijing from Western economic pressure. As more countries turn toward China's financial orbit, the real question is, will the dollar maintain its status as the dominant global currency or become merely a regional currency sustained by legacy? The Treasury expects to borrow $514 billion in the second quarter and $554 billion in the third quarter to reach a cash balance of $850 billion. However, as of mid-May, they had only reached $563 billion, up from $46 billion in March, but still falling short by 33% according to their statement released on Monday. Analysts at J.P. Morgan are sounding the alarm, suggesting that the market will not continue to ignore the gap between financial commitments and reality. Rating agencies like Fitch and S&P Global are also beginning to question the U.S.'s sovereign outlook, warning that the Treasury's cash management strategy needs serious reform if Congress does not act. With BRICS building alternatives, China offloading dollar debts, and even allies on the defensive, the U.S. faces a clear choice: reform its fiscal strategy and foreign policy or witness its financial dominance quietly replaced not by force, but by arrangements. The numbers do not lie. Mortgage rates are rising. Reform its fiscal strategy and foreign policy, or witness its financial dominance quietly replaced not by force, but by arrangements. The numbers do not lie. Mortgage rates are rising. Investor confidence is weakening. The global economy is shifting the center of power. Beijing is not waiting. BRICS is not slowing down in Washington. They continue to bet on traditional power to maintain cohesion. However, the debt clock does not stop for politics, and the market does not operate on nostalgia. So the question is, what happens if the next U.S. Treasury auction fails? What if allies start viewing our bonds as risky instead of safe? Leave your thoughts in the comments below. Because from soaring interest rates to the volatility of the reserve currency, every nation, company, and household may soon have to choose sides. Hit the subscribe button, turn on notifications, and join us to see whether America's economic leadership will crumble or be rebuilt. Thank you for watching. Please like this video, check out more of our content, and continue the discussion with us.